follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. What's happening, everybody? Happy Monday. How we doing? It's going to be a pretty wild week ahead. A couple of weeks, actually, to get through Q1 and end of the month expirations. So having a look here, my copper position maxes out around $160, and I've got $150 to show for it. So it's about 86% of max profit. It's way out of the money, so there's not really much I have to do for it for the next 38 days. But if I want to take the profit, I can. Put on some hedges. That's going to be important. I think we'll talk some big technicals today. Watching Bitcoin pretty closely. I have some. This is a little income trade for next. Next Friday. So max profit 67. I'm up about $40. I'm going to free up some buying power here. I did some puts on this. So I've got 67 cents. Should be probably trading for like 27 cents or less. Let me see what I can get out of here. 28 cents. Let me see if I can get out of here for 28 cents. 28 cents. Go 29. 30. I'm just going to take the 50+% profit here. Don't make me go to the ask price. That's embarrassing. You're a better broker than that, Tasty. 31 cents? Come on, dude. 32 cents is the ask price. All right, close out for 32 cents. Getting some buying power back. Okay, so that was a little income trade on IBIT. Other ones are looking fine. Fine. This is out to May. This is out to May. Has some shares collared, whatever. Okay, good. Now, let's talk some positions. I do have to get a snap rolled. So this is Snapchat trading at 875. I've got a call this Friday at 950. That's 94% already in profit. But I'm just going to go ahead and roll it. And let me just double check my break even on Snap. So let's go to the tracker. Snap. All right, so my break even is 912. Let me see if I can do a quick roll on this one. So roll this out to the monthly expiration for April. April 17th is 16 cents credit. I get 46 cents on this one. This wouldn't be terrible. So if I go 912 break even, minus 46 cents, 866, get it called away at 9. And I've got 300 shares. I make a little repair there, $100. Not awful. I mean, are we getting back to $10? Let me check on Snap real quick. Trading at 874. I mean, I'd like to think in this like $8 zone, there's at least a squeeze. I mean, we've had solid earnings growth on Snapchat. I don't know why they're not having any type of profit unless it's like they're just spending crap tons on AI. But, you know, there's revenue. They're beating EPS. They've done that for a lot of, I mean, I don't know. I'd like to see them do better. This is a COVID crash low around 850. So, I mean, I think we have some support here. So possibly, let me look out into May. This one's, it's not costing me an arm and a leg. If I go to the May 16th, get it called away at 10, that's not awful. So let's do 9.12 minus 57, get it called away at 10 on 300 shares, make $435. I'm okay with that. All right, I'm going to do this. So I'm just going to roll my 950 call that expires this Friday. That's mostly in profit. It's only trading for a couple pennies now. I'm just going to roll this out to May and up to $10, and I can still get 55 to 57 cents in this trade. See if they'll be generous and fill me at 57 cents in this roll. 57 filled. Okay, so that's good. I'm going to update this right now. Rolled to 5/16 expiration. $10 sell call for 57 cents credit. So that break even is 8.55. All right, so that's a rollout on Snapchat. Let's talk technicals on the bigger picture. Why do I think this week is so critical? All eyes on the Fed, although they are not likely to do anything. What they say, language-wise, comments, Powell's, press conference, is going to be important to kind of lay out the groundwork for what they're looking for, expecting to do this year. Right now, the market's pricing in 3 cuts. I will take a screenshot of this right here. Let's go take a screenshot of the FedWatch tool for today, March 17th. March 17th at 10:25 a.m. Eastern Time. Okay, so I just want to reference this. So that way, after the Fed, we'll obviously watch what price action does. That's the most important thing to me. It's not really what Powell says, it's what the market prices. I don't know what he's going to say that's really going to, give the market a reason to rally. I don't know what he's going to say that's going to give the market a reason to fall. If they come out with like a hawkish tone, then yeah, I can see the market falling because the Fed's not being accommodative enough. We're already worried about Trump and tariffs and the current administration, basically gutting all government spending. And that's the extreme. Like, it's not actually happening. The government's still going to spend a crap ton. We're probably still going to have a fiscal deficit, but it's the optics of having Doge there that has $1 trillion+ in mind, $1.5 trillion in mind. I've read some pretty surprising stuff over the weekend. In 2024, what I read is 34% of GDP was government spending. 34% of U.S. GDP, 34% of U.S. GDP came from government spending in 2024. That's a record. If you exclude crisis, you exclude wartime, you exclude crisis, that is a record. So we are operating from a fiscal policy standpoint as if we are in a crisis mode, recession mode, wartime mode, and we're clearly not yet, but still, unsustainable is probably the easiest word to explain it. I get what's happening as far as like why do we have the need for it. I just think that it's coming at a pretty terrible time. But that being said, I want to make a reference to this because now that fiscal policy seems to be on the decline, and we don't know how bad that's going to get and how bad this administration could potentially exacerbate those moves. But if the Fed, which is potentially going to be cutting rates this year, are they cutting rates into a recession? Maybe, and maybe it's not a Fed-caused recession, but the Fed will still be cutting when the market's still down anyway. So overall, here's my concern, and this is what I thought a lot about last week. This is how I kind of positioned a lot of my portfolio for the rest of the year. If this market is going to be, finding some lows and finding some resiliency, hooray. Do I think the all-time highs are possibly going to get tested this year? Maybe. I'm not sure if I shared this everyone on Friday last week, but let me go into this chart here. Okay, a couple things. Typically, if we get through the little lull of February and March, usually by March, April, the market picks itself up. We get a seasonal trend. This is called the pre-summer push. April, May, June, July, some of the biggest bull runs ever. So usually from, this is 70 plus years of trading. You get a nice seasonal trend right in here. If that is absent this year, we should all be hoping for a good Q4. But if it's absent, I don't know. This is all bets are off. This is like just going to be one of those years where you hope you don't get burned too badly. You're playing defense, and that's exactly what I'm doing. So point is, if we can get through this, which we had a nice little cleanse, the market was down 10 to 11% on the S&P, 13 to 14% on the Nasdaq, nearly double digits on the Dow. We've got the Russell down nearly 20% or right at 20%. I mean, that is in fact, I think I read this. This is the 6th fastest decline. So from peak to trough of over 10%, on the S&P. That's the sixth fastest time it's ever happened. So, and again, does that mean anything? Not really. It just means that our cycles are so much more accelerated now that things move faster. But I don't think that the bottom is necessarily in. Um, you know, if we're going to have resiliency, what do we need to see? We would have to have inflation trending lower, Fed willing to cut. We'd have to have the consumer willing to spend, and the consumer still have jobs. Okay. If this can happen, and I'm saying the consumer as in like not the federal government worker, you know, that cut those layoffs. I mean, I think right now Doge has I don't know if we actually officially had the layoffs, but to what I'm reading, about 60 plus thousand jobs right now. It could be way worse. There could be hundreds of thousands of jobs. But for private sector, if we still have the consumer employed, we still have the consumer willing to spend and willing to kind of maintain cost of living standards. I mean, we probably need to see a housing market resiliency as well, which we're starting to see some applications picking up. But inflation trending lower, we saw that last week. Does it continue that way? We'll find out. The Fed is willing to cut and be a little bit more dovish and accommodative. Okay, fine. But I think this is going to be needed for the markets to stay resilient. Okay. If all of a sudden we see that the consumer is unwilling to spend and consumers are losing jobs, and we're starting to see initial jobless claims ticking higher, we're starting to see continued jobless claims ticking higher. If the housing market is still kind of frozen, if interest rates aren't going down too much, if the Fed is, I mean, the Fed could be willing to cut, but in the wake of a recession, the Fed is going to be cutting and the market doesn't really care. The market's going to drop regardless. So the Fed isn't necessarily going to be saving the market, in my opinion. I don't think. So a Fed put could be way lower than what the market is sitting at right now. Everyone's talking about the Fed put, the Fed put. Right now, it's not even a Fed put. It is a Fed put and a Trump put / administration put. If there's no backstopping this market can clearly have a pretty nasty correction. Again, I'll look at the bigger picture, but I've already looked at like a 20% area that seems pretty doable to the downside. And that's not going to be a lot of fun for anybody, but I'm just saying that wouldn't be a huge surprise to see us ultimately get there if a lot of these things are kind of this current changing of the guard. This is becoming like the new normal with a austerity-driven administration, at least for the first 6 months, 9 months. Again, I think they're on borrowed time because midterms are going to depend on what they can get done. If nobody's happy with this current administration for the first 2 years, you're going to notice it in the midterms. You're going to have this big pendulum swing from one side or the other. It's going to be all Republicans, and then it swings back to Democrats, and they lose the House and they lose the Senate. There's no more majority, and then you're right back into nothing can get done. And then Democrats maybe come in swinging, and they're trying to put things forward. You got a president that's going to veto everything. Like, it's going to be back to gridlock again. Political circus is always happening, right? But point is, if we have a correction, we have an intermediate low, that's understandable. My biggest concern is that this is a setup for more bad stuff. And this is what's scary about the markets. The reality is everything could be okay, right? But the market is always forward thinking. And if the market thinks that there's a recession, if the market thinks there's more job cuts coming, if the market thinks that consumers are going to be struggling and pulling back, the market prices that in. That's the downside. Even if we would technically not be in a recession, the market could show it. 6 to 8 months forward thinking. So that level of resiliency needs to be communicated now. Because if it's not, this market's going to start pricing in things that are worse. Or this reality that's kind of lining up for 6 to 8 months from now. If we don't get better news, then the market's going to price it in. And I don't think that this little 10, 11% correction is going to be the lowest. Now, historically, something like this I thought was pretty important. That it's not necessarily where you start, but it's how you finish. So we're off to our 18th worst start since 1928. And those even these crazy terrible starts. Look at this price return for the first 48 trading days. You notice some of these levels, like, yeah, they're awful, right? 2009, right out of the great financial crisis. 2020, that was during the COVID OPEC cycle from February to March. It's a horrible window. 1935, I don't even know why, right? Great Depression was 1929, but 2022 was the start of a bear market after a deleveraging that happened in late 2021. So we're off to a pretty rough start. So at least in my my career, my era, I saw that happen. I saw that happen. I saw that happen, and I saw that happen. I saw that happen, and here we are now. I'm watching it live. Even 2000, watching it live. So point is, we've had of these 17 worst starts. Of these 17 worst starts, 10 out of 17 times the market still finished the year positive. So and it's not an awesome stat, but it's about 58%. So is that a big enough edge to say I'm going to put all my money on the market finishing higher for the year? I mean, it's a calculated bet. But I'd say if you're at least protecting the downside, then yeah, you've got probabilities on your side. You've got time on your side. If anybody's looking, let's say 3 to 5 years out, there's really not much to worry about. If you're looking 3 to 5 years out, there's not much to worry about outside of don't lose your butt if this market's going to fall, 20, 30%. Worst case is if we fall 20, 30, 40, 50%, I mean, there's a lifetime of wealth that can be generated in that type of drawdown. But the problem is are you going to survive it? And that's where most traders don't. Is most traders are already overextended and already over leveraged, and it's that decline that makes them panic, and all of a sudden they lose all faith and confidence in the markets, and they get out, and all of a sudden that 100% upside they'll never feel, and they'll never experience it. So, and look, that's why if you think about it, like most like self-made millionaires are people with 401ks for 20 plus years. That's the craziest thing about the dollar cost averaging approach and just staying in the markets regardless is those consistent flows of wherever the market is, up or down. 20 plus years in the market, it's done pretty well. You can go back any stretch of time. Yes, you've had some ugly drawdowns, but most of the time over a 20-year window, you could have the worst possible buying level and still make money. So I'm not saying it's easy. And it certainly feels like crap to watch this market if you're, now becoming more active in your portfolio and you are dealing and navigating with a potentially a massive correction. It's not fun, you know. But just saying, um, time in the market helps. Time in the market helps. So there is a slight possibility that yes, the market finds some resiliency, finds some lows, and we deal with like a bunch of noise. And this might be, the low might not be in, but we might have like a bear trap, and then it gets back above the 200, and the market finds a reason to move. Do we get back to all-time highs this year? Yes, no, maybe. My biggest concern right now is looking at the bigger picture, zooming out, and we have previous all-time highs back in 2021, 2022. This is on the S&P. The Nasdaq would be the highs back in 2021 in November. But my biggest concern with that is that this level is now just going to be the play zone for the bears to, try to maintain their control, and the bulls will just end up running out of resiliency. And so the bears take over, and then this open space, this probably would feel worse than what we just experienced for the last, 3-4 weeks, because there's nothing to stop it. Outside of this August low, there's really nothing to stop this market. So that is certainly my bigger concern in 2025, 2026 is if we start breaking some critical levels, we can give back a lot of gains very, very quickly. And, I need to make sure that I'm playing defense for that. Okay. All right. Lee's asking, at what point does the correction become a bear market? The textbook definition is at 20%. So we are in, correction mode is always considered anything, I'd say the comfortable correction mode would be between about 5 and 10% would be correction, because that's very common. You get like 10 to 15, you're talking, deep correction. And you're talking 20 plus, you're talking bear market. And now it has to be like you have to see a shift in direction. The 20 plus percent is don't catch a falling knife. If it's 20 plus percent, it could get worse. I'm not saying that 20% is automatic. Hey, buy the dip. Historically speaking, if you give yourself, again, 3, 4, 5 years plus, if you're buying with a 3 to 5 year outlook and you're already starting at a 20 plus percent discount, the odds of making money are very high in your favor. But if you start buying at a 20% discount and the market still drops another 10, 20%, okay, you still got to ride it out. Does it get back to all-time high? I mean, that's the journey, right? So it's never a clear path. It's never easy. But a correction market to a bear market, that's why bear markets are usually like over fast, is because they're so violent, so ugly. And again, I don't know what's going to happen, but I do know that if the market is going to be dropping, I want to be making sure that there are ways to alleviate some of that pain. So, for example, I've got some hedges on right now that it's about 1 to 2K in risk to pay out anywhere between 6 and 10K in profit. That's on average. So just keeping the number simple. So if I put in 10K on a hedge that has the ability to pay 60 to 100 grand. I mean, that can offset and alleviate a lot of pain for me to then, play defense, button up some exposure, not overtrade, and just, also be kind of braced for more downside and just be patient. That would be, I mean, the best approach might be yes, I'm going to actively trade through things, but if this market turns over, like I will be actively selling this market. And that becomes pretty straightforward with like bear put spreads, bear call spreads. There's all sorts of fancy ways, but like what I don't want to do is be consistently calling the bottom, because you never know how fast and aggressive this market can fall. All right. But point is, I mean, there's corrections. We've been spoiled by these like 1 and 2% dips, 1 and 2% dips, 1 and 2% dips, and they have worked. But a 5% correction, which we saw in April last year, a 10% correction, which we saw in August last year, now looking at another 10% correction, what we saw in these last like 4 or 5 weeks. If we get into deeper territory, double digits, 20% is called bear market. If you get the death cross with a 50 period and the 200 period in there and they're crossing over, that's the death cross, that if the market can't respond with a move back above it, then look out below. Right. And so we're not there yet. We're not in death cross territory because it happens so quickly. These are moving averages for a reason. So right now my 50 period is probably this one. Yep. So my 50 period is right here with all the little dots on it. So my 50 period is here and my 200 period is here. So we would have to flop around here for a while to have maybe everything come in coiled, and all of a sudden we get our moving averages coiled. Maybe we put in an intermediate low and the market's not going anywhere. And then the next part is, well, if it breaks and goes lower, there's where this thing accelerates again. If it breaks and goes higher, then maybe there's a little bit of relief. I don't know. I mean, seriously, if the Trump administration is using the markets at all for any barometer of approval of the administration sentiment, they should be careful on how much animosity and adversity they cause in the markets. They should be careful. And they're saying that they're not. Trump hasn't tweeted at all about the markets. They've said expect there to be. I don't care. I'm not getting the politics here. It's nothing I can control. But this is a recession. There's no ifs, ands, or buts. If we're going to be down, 15 to 20% in these markets, there's going to be a recession. And the bad part is this recession could be felt a lot differently because you've essentially had 4 years of consumers just scraping by, knowing that things are not really getting better, and now it's just getting worse again. So that reset to the consumer could be all the more hurtful than it was back in a mortgage crisis, when people had 3, 4, 5 homes that couldn't afford it, and that was just a bubble waiting to happen. This, I don't know what you call this one. This would be, I don't know. I would feel rough that this would probably be like the worst like Main Street recession that we have seen, since 2008. 2008 was awful, okay? But this could be one of the worst Main Street recessions because consumers have been basically living on debt, dropping all their savings. The only money they have on paper is sitting in their home. But because everyone refied during COVID and they're sitting at sub 4% mortgage rates, and they're squatting in their homes because they can't afford to move. Prices are at all-time highs. Interest rates are still crazy high. But if prices have been passed on to us and we've been able to live and survive, at some point it's like, screw it, stop spending, cut back. And what you don't want is, you don't want a consumer to lose jobs. If we start to see a recession with job losses, it could get really bad. So again, like, I'm not pricing that in, but I've got to be hedged just to be on the just in case. There's definitely a just in case scenario with my trading this year. Until things get, and this is the hard part, until things get more clear. I don't know when that's going to be. I will say that there's some pretty key deadlines here from the technicals. Right now, JP Morgan, one of the biggest investment banks in the world, they have a fund that typically has, it's called the JP Morgan collar. Okay. And it usually runs about 40,000 SPX contracts. And that provides a resistance level in the market, because it's where a lot of option flows will gravitate towards. They're hedging towards it. They're hedging off of it. Resistance level, which would be sell calls. And then you have your support level, which is going to be your either your buy puts or your sell puts, that all your option flows are going to go on. So, I mean, granted, I know this isn't the only game in town, but big market makers and big institutions are oftentimes positioning off of this. And right now for March 31st, so 3/31 expiration, which is not today or next week, but the week after. So we've got the 17th, the 24th, and the 31st. That is going to be your quarterly expiration. So that's going to be your Q1 expiration. Right now, that put level is 55.65. So at least for the next 1 or 2 weeks, 55.65 should be acting as proper support. Okay. Does that mean I'm getting crazy aggressive off of that? No, it doesn't mean that at all. But it means that based on where I see the option orders coming in and the gamma levels that I'm watching on my charts, I could see that level being a reason that this market found a bounce. Right? We came down right around 55.50 or so. What was our low from last week? Thursday was our last low. Yeah, Thursday was our low, and that candle was 55.04. 55.04 is a little bit of an overshoot from that 55.65 support level. So I could see that holding, and I wouldn't be terribly shocked if by the 31st we're still sitting above 55.65. Right? And then what's going to be interesting is that day or going into the next week, because 31st is Monday, then you go April 1, 2, 3, is you have a couple other key levels and deadlines. You'll have end of the quarter. So you'll have 3/31 or early April. You'll have a new JPM collar. Okay. Or you'll have a new levels. And so if we're sitting, around these lows, because and I was roughly guesstimating this, but by the turn of the end of the year was around 5,900. Turn of the year is around 5,900. So if we looked at this like 55.65 as it's about 335 points lower, and I'm imagining that pretty comparable to that, it's going to be somewhat delta neutral, a 335. If there's any skew to that, maybe it's slightly more to the upside, but depending on where we are at, okay, let's say that we are hanging out around like 5,700. Well, based on current environment and current volatility, there might be another 300-point move lower and another 300-point move higher, right? So that new collar position, or that new kind of resistance level at the call side and support level at the put side, might be sitting at 5,400, right? 5,400 is obviously lower lows, but it also makes me a little bit more nervous that it's just more open. There's just a lot more open space below, let's say below 5,400. A lot more open space. So this is something I'm going to continue to kind of monitor and track. It's not foolproof by any means, but when it comes to, look, market makers that have been trading options since 1970s, this is their job. So if the market is going to be falling aggressively, they are properly hedged to make sure that they can still make a market. If they don't do their job, they go bankrupt, right? So they have to have the money, the cash, the inventory available to provide liquidity to the market. That's why these levels are so important. Okay. So point is, where we are sitting coming into Q2, like kicking off April, where we are sitting will be pretty important. Because if we're up here towards like 58 or 5,900, then we might see that support level just a little bit lower and that resistance level sitting just above these highs, and the market's right in the middle. We could come down and test the lows again. We can maybe, I mean, I'd say the higher probability is that we come and test the lows again versus retesting all-time highs. If we retest all-time highs, I do think that somehow gives the market a big sigh of relief. Otherwise, we're setting up for like another, here we go again, like just another big roller coaster ride. But I don't know. Okay, so there's that. And then on top of that, you come into April, which I want to say it's April 2nd. So April 2nd, we have retaliation talks on tariffs. Okay, so what happens between the US and Europe? What happens between US and additional retaliatory tariffs in Canada, Mexico? Mark Carney. If anybody knows, I mean, I don't even know what his job is right now for Canada. Is it prime minister? Is he prime minister? That's right. Or is he just like finance director? I have no idea. Mark Carney. But he's been from Canada to the UK. He was like the Bank of England's guy for a while. Right now he is, so he's the prime minister of Canada. Okay. He was the Bank of England's director for many, many years. I want to say he was the Bank of Canada's director for a while. I don't know. This guy's been in and around. It's whatever. But Canada's not just rolling over. I don't know. It's just so much crap, man. It's so much crap, and we got to trade through it. But there's stuff that matters this week. The Fed is this week. Price action matters. We've had this huge decline in the last 6 weeks of trading. I do think there's a short-term rally. The sentiment has been really, really extreme, right? I mean, I read from Steve Sosnick this morning, Interactive Brokers. When you get the AAII sentiment survey showing the extremes that it is for like 3 straight weeks, usually, Bank of England governor. That's right. I mean, it was for a while. It was like during Brexit. He was the guy during Brexit. Probably not a fun job. But for 3 straight weeks, we have seen this was literally like at this high level, this differential, about 40% difference between bears and bulls. We're talking like 2009 levels, like post Great Financial Crisis, when the market did rally pretty hard off the lows. But it's not the same. History doesn't repeat itself. It often rhymes. And the sentiment swings are really, really extreme, which does tell me there could be some bounces coming. But market breadth wise, I don't think the worst of it's been priced in. So I'm not overlooking the fact that we may not be in for the bottom. If it is the bottom, freaking great. If it is the bottom, then trading is easy. If it's not the bottom, it's how much more pain is there ahead. And I just don't want to be caught on the wrong side of that without having some defense plays. And that's hedging, and that's lightening up positions. It's having cash at the ready to deploy at a much better price. So my job is simple. Just don't do anything stupid. If we get pleasantly surprised the upside, awesome. But I'm just not crazy aggressive right now. I don't want to be. I shouldn't be. I think there's more uncertainty that I need to navigate, and I certainly don't need to overexpose. Okay. All right. So anyway, that's what's going on. Between this week, Fed on Wednesday, here is your snapshot. Does this change at all? I'm going to compare this on Wednesday after close or Friday when we're wrapping up the week. Does this change at all? Right now, I mean, the likelihood of a cut in March is pretty much non-existent. So there's likely not going to be anything. But what we may end up seeing is this June and July, maybe it shifts. Right now, we have about an 80% chance in May that nothing happens. Does it shift? Maybe the first cut is in May, and then the next cut is who knows? If it shifts, watch. But if that is somehow explicitly said, I doubt it. But if this is somehow what the market is sniffing out and pricing out or pricing in, that might help give the market a little bit of a boost. That if the market's anticipating 3 cuts, maybe the Fed is willing to cut a little bit sooner. I still don't think that's the greatest idea because I still think there's more data that needs to happen. We still have inflation data that's sticky as heck. So we're just in this crazy environment. And meanwhile, I say all this and it's just like all this focus on US. Look, a lot of liquidity and a lot of options that I trade in the biggest markets in the world are US-based stocks. The S&P 500 is one of the largest markets in the world. It's the most liquid market in the world. So for me to say like, well, I'll just trade Germany. I'll just trade the Euro Stoxx 50. I'll just trade the FTSE. I'll just trade. It's not the same. So the tools that I have to trade are a lot different. I mean, you have Mag 7 or your top 10 stocks in the US that are larger than most developed countries' entire economy. So that's how large the US market is. So when it comes to the trading and options market, I still like US equities, but there is a clear rotation going on right now. And I think the important thing is this is also an interesting trend that if you look back to the first like 50 to 75 days of trading, any sector that's been leading typically takes the reins and runs for the entire year. So if anybody's looking to diversify this year, rather than being in tech and rather than being in what is not doing well, energy is probably positioning for. And energy to me is a question mark, because if we break the lows of $60, energy is not going to look great if oil prices are dropping. So this is probably my least favorite diversifier right now, although I do have some energy plays, and I'm going to take a look at that in a second because I have some puts on XLE. XLE. Okay. And those are looking fine. I might end up closing those. I think they're either this week or next week, but I'll double check that. But the other sectors that are looking pretty good, healthcare I like, and utilities I like. Okay. Materials, maybe. I mean, we're slapping tariffs on steel. Aluminum prices like Alcoa. I follow Alcoa. I like Alcoa when the market's rallying, and Alcoa is kind of garbage right now. But materials, I mean, copper, aluminum, steel, tariffs aside, it's like if there is a demand for these things, I don't know. It's not a bad play. And this is also like classic rotation away from discretionary when people are scaling back, and away from tech, which is typically your growth cycle is starting to slow. When growth is starting to slow, discretionary is where the consumer cuts back, and technology is the rip roaring, paying the high valuations for basically overvalued stock. It takes a big correction. So I think healthcare is probably one of my favorite. Um, Healthcare has been one of the most consistent sectors for jobs as well. I think it's going to continue to need more. Um, I mean, I think insurance is a joke, but it's our system. I mean, we don't have universal health care, at least comparable to Canada or comparable to Europe. Um, we can argue it all day long. It's not fun. I mean, I don't know how everyone feels about their insurance in the US, but I'm certainly not a fan. But it's what it is. Point is, these tend to trend and lead the way. So if we're looking out 12 months from now, this may be the leading sector for the year. You're looking out 12 months from now, this may be the leading sector for the year, right? So what are these? These are typically non-correlated to the S&P. These are typically much lower beta than the S&P. So let's show that. Let's go to XLV. XLV with a beta of 0.44. That's, half, right? So it's way less correlated to the S&P. And you go to XLB for materials, and you're looking at a 0.75, a little bit more correlated than I'd like. Let's go to utilities. XLU should be a very low beta here. 0.39. Yeah. So if you want to be diversified and have like way less volatility, healthcare, utilities, pretty good. Energy is trading up to 90. These expire at the end of the quarter. So I've got an 83 2-1 put for $1.41. I think I closed these out already, but let me double check. So XLE, nope, I still have them in. So max profit's about $1.43. I'm up about 55%. I'm good on that. I'm going to let those expire at the end of the quarter. So that should be fine to let it expire. But yeah, I mean, it's not that difficult. There's still going to be some pain. There's no guarantees that just because this is green is going to stay green. If this is more red, this is more red, this is more red, then this probably goes flat, flat, flat. But it doesn't perform worse, right? It may not perform well, but it might not perform worse, and that is still considered defense. So, sectors to consider. Energy, probably my least favorite though. Healthcare, utilities, possibly materials. Materials a little bit more beta, so it's close to correlated, which I don't love. But utilities I really like, healthcare I really like, energy. I don't know, energy. If we go from, fossil fuels into nuclear, if we go, I don't know. I mean, I think with Trump, I think the clean energy stuff is done. Like, this administration probably could give two shits about clean energy. It's driving oil prices down. It's drill baby drill. And U.S. and Saudi Arabia are the two countries that can have the highest market share with low oil prices, and it's going to cause a lot of pain. I don't know if that causes a war in the near term. I don't know, but probably energy as a diversifier, yes. Non-correlated, yes. But if we get below $60 and break major support, I don't know what that looks like. But healthcare, utilities, probably some of my favorites. Okay, Euro stocks. So DAX doing well. FEZ. So I had kind of a deep dive on Euro stocks this weekend. Obviously, this is what I think good exposure to have. I'm in the FEZ. I don't mind participating in this. My only concern is that Europe is not really spending money on infrastructure. They're spending money on defense. They're spending money on weapons. That's not a multiplier. Spending money and building a weapons armory and building like a wartime war chest is not a multiplier for GDP and for growth. So I get it that it's the money is going elsewhere and it's kind of vacating the U.S. and what's been overvalued, and money's going to where it's been just super undervalued, and Euro stocks continue to be undervalued. But I would hope that the spending that's going on, like the kind of the opening the fiscal wallets up in the Eurozone, I'm hoping that's willing to go into um, like programs to grow GDP, programs to build infrastructure, programs to make the Eurozone better, as opposed to it's a war zone. I mean, somebody referred to, I was listening to a podcast this week, and they referred to the Eurozone and war zone as like the kind of the white people's Middle East, which in a way with Russia, Ukraine is kind of true. But anyway, I mean, I don't mind having the exposure. I think there's maybe other sectors or other areas to go that may look a little bit better. But I still have FEZ exposure. I don't mind showing that, yeah, this could still outperform. The FTSE has been okay. It's pulled back a little bit. The FTSE is showing some resiliency. We're just pulling back to some dynamic support levels. But as long as we stay, I'd say, stop loss wise, if the FTSE breaks below these lows, like I don't want to be in it. But if we are going to stay with higher lows and lots of consolidation and higher lows and consolidation and higher lows, higher highs, not a bad spot. There's a recent dip here to buy off of. So we'll see. Copper. Let's go copper futures. Copper futures just rip into the upside, which is, I mean, fine. I like the position I took. It was a little income trade that's almost like 90% profit, which is fine. I don't know how much more bullish I'm going to get on copper necessarily outside of participating in some of these like pullbacks. And then gold. Gold is at 29.97. I think the big wonder is like if gold is just going to be this like gangbuster rip. Maybe it is. I still find that gold, from a technical standpoint, if we are going to enter into some type of capitulation move, we've already stretched a decent amount of way. I measured this out a lot last week. A 15% move higher than this moving average is quite extreme. So I took a position on this one last week where we're sitting up around 14+% above the 200 moving average. We have 360 bars right now above the 200 moving average. So I am basically positioning for a bit of a topping pattern in gold. However, that topping pattern, I'm not having any type of threat until price is above 32.50. So for me on gold, I don't have any risk on this trade unless we're trading above 32.50 by like April 24th. So it's a short trading window. If this is just straight bullish, then yeah, maybe there's some risk here. But if it just pops up here and then consolidates, then my trade is fine. I also have a bull call spread. So if we go up, I have a profit trap and then I take on risk at 32.50. So that's an income trade. I'm still waiting for pullbacks. I'm hoping we have some. I mean, this is crazy. This is only pulled back to a 21 moving average. And most of these pullbacks here for the last like couple of years have been next to nothing. Like these pullbacks since this breakout in 2023, it has been at best the 21 and the 50 moving average. Okay, right here we pulled back to the 100. I think we tapped the 100 right there. That was it. And that was just a little wedge that broke out again. So 21 continues to offer up like really dynamic support. And it's kind of crazy. So anyway, gold is a great diversifier. I don't know how silly and crazy gold gets. Gold is certainly one of the best performing assets so far for the year. If you go up to the 12-month candle, gold is probably outperforming most indexes right now, certainly outperforming Bitcoin. We are sitting here with gold at the start of the year. I mean, I don't even see a wick. The low of the year at 26.14. So we have a wick that's 10 points lower. So this thing started out with a close for the year, a little blip hesitation to the downside, and this thing has been just straight up. So gold from open to current is up 14+%. I mean, it's keeping pace with some of the best indexes in the world. And for a safe haven seen asset, that's pretty remarkable. And for the yearly chart, I mean, this is also a interesting stretch. This low to whenever we put in some type of high, it's like this cycle 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is 10 candles. So I don't know. I mean, do I think gold looks good? Sure. But I want to have gold in my portfolio. I just want to buy at better prices. And I'm hoping that I get them. If I don't get them, then I guess I'll just continue with the melt up and enjoy gold being this like amazing safe haven that you hope the world doesn't freaking crash. And then gold's, I mean, I don't know. Obviously, gold can get even like gold can go ballistic. I think that's the scary part is we don't know if gold's going to turn into like a Bitcoin type rally. You know, I mean, even this, like it's up 14%. Okay, big whoop. But if this year turns into a 14, 20, 30, 50% correction, or not correction, but a rally, I mean, I don't know what the biggest rallies per year have been on gold. I would imagine we haven't had too many like 30, 40+% years. What's some of the biggest years we've had on gold? I'd imagine a big gain on gold to be like 20 to 30%. Let me look at some of these, monster candles here. So 2010, gold was up about 30%. That's a big year. This low to high volatility, that was a 47, 48% move, but a lot of volatility and ended up being a fade move. We obviously had a huge crash here in 2013, 14. Don't really recall why gold crashed that much, but it was down 28.5%. And then it built back up. We saw some gains. There's another big candle to the upside, about 25% that year. Last year was a very bullish year for gold. Gold was up and it beat the market. Gold beat the S&P for the first time, I think, in a long time. I think, yeah, I mean, it's crazy. You're 26+% from what I'm just roughly measuring there. All right, anyway, let's see what happens to that $3,000 handle. I think everyone's talking about it. Does it really mean anything? Does it show any type of resistance? I don't know. I still look at the stretch away move from this bar count. Unless we're going like parabolic or exponential type rally on gold, I could see this, I don't know, just maintaining bid, but just kind of stalling. It depends on, I guess it depends on if big institutions are coming in saying, look, gold still looks attractive, buy it. You know, the amount of central bank buying on gold has been increasing dramatically the last probably 3, 4, 5 years. And if there's more, institutional money flowing into gold, then we're probably seeing another, nice bull market on gold. So something to watch. I, for one, hope that the poor man's gold, silver, continues to look pretty good to the upside as well. I'd love to see if we're going to have a bull market in gold and continue to stretch, I'd love to see silver doing the same thing. If silver can get up into the 40s, I would be thrilled because that's a pretty decent gain in my portfolio when I own the thing down here in the 20s. So anyway, and then there's Bitcoin. What's it going to be? It's either the, greatest asset ever / equalizer of those that missed out for the last 20 years of American exceptionalism to having some type of asset that's going to change the world. This is all, take it with a grain of salt. But I really think that Bitcoin this year, especially, critical resistance becoming support. If we do too much damage below this like $56,000 mark, if we do damage below these levels, my concern is that is a monster top and we're going to see like a 70 to 80% correction of Bitcoin. And all that will be left will be your Bitcoin enthusiasts down here that are willing to basically just walk away, put the tail between their legs and not look at it for a while. And then all of a sudden, maybe Bitcoin is up. But I would say for the institutional side with, ETFs and BlackRock having its hat in the game, Michael Saylor's essentially his entire reputation rides on Bitcoin because that's the only way MicroStrategy is profitable right now. If this level holds and this semblance of a trend can hold, then sure, Bitcoin looks better. But I don't think you get Bitcoin bulls without a broader market. It's like maybe I would say bull market. You'd almost want to see a bull market in the equity space in order to have Bitcoin also look good. But if we see additional drawdowns, that risk on will just get pulled out of the market. This is where deleveraging is really obvious. Yep. So it's true, Lee, but also with China too, it's like now it's telegraphed what China's doing, and I think China's hopefully looking to buy. I mean, calls are expensive, man. With this increase in volatility that we've seen, this swell in volatility, calls are more expensive, puts are more expensive. If you're paper trading it, but obviously the physical gold it's at a premium. So, but who knows? I mean, if gold's going up to $4,000 an ounce, then it's still a good investment. So we'll see. All right. Anything else for today? I think I covered a lot. It's just kind of it's big picture stuff. What's important this week? We've got the Fed on Wednesday. Unlikely to change, but what is the language that they give us on Wednesday for any type of upcoming rate cuts? Are they, pretty certain about 2 to 3 cuts? Are they going to actually say anything explicit? Does Powell leak any type of transparency in the market that the market runs with? From the technical side of, S&P, it's a pretty simple swing from high to low. We are at the 236 pullback right now. If the market can somehow get back to this like 30% zone or 38% zone, this is a little bit of sigh of relief, is pulling back to like the 38 to 50% pullback zone. I still think the market's going to be met with a lot of resistance in here. So at best, I think the market, if we pull back to, let's say, like 5,800 to 5,900, that's probably the at best pullback in my opinion. But the concern is that the bears are just so ready and so eager that this thing hits like 30% and then just retests the lows. That's my concern. And not just retest the lows, but claws at the lows. And then there has to be like this, drama at the downside. And is it going to be volatile? And like buckle up, because there could be all sorts of head spinning volatility in the coming weeks. Like I said, that quarterly expiration, the seasonality. I mean, I don't think this is something to ignore. Typically, the market does have some good seasonality, which would mean like April, May, June, July usually have a pretty good run. But if there's nothing optimistic to price in, I don't know how the market really rips. I could see the market stabilizing, but what's the market going to rip on? Maybe a pullback, but still not enough to take out any all-time highs. And then we come into August, September. This is where we're talking about the big like refi bubble in 2025. That's going to be the big refi bubble that the clock is ticking on the Fed with whether or not they're cutting rates, and are they cutting enough rates to make it worthwhile to then finance and refinance at affordable levels. So if we're not fixing things in these next couple of months, then I don't really have a super positive outlook for the end of 2025. That's it. So we'll see. But all right, continue to grind as usual. Let's do it again tomorrow. All right, thanks. Bye. Okay, we're gonna let this dead air run. Chandler, James, I'm gonna wrap it up. I got a class in 5 minutes.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below, or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.